There's been talk about problems with liquidity. Do you see that?
I certainly don't see problems with liquidity. I mean, what I really see is the market has started to be more convicted about near-term growth, right? I mean, if you think about how we came into this year with rates, sub 1%, there was a lot of concern about, the vaccine, the mutations of the virus itself, the ability and the speed at which that vaccine will roll out. And obviously we came in with very high levels of the, I would call it the hospitalization rates and death rates associated to the coronavirus. Really in the last 3 to 4 weeks, you've seen the vaccine start to pick up pace with regards to its rollout. Now about 15% of Americans have already seen one shot. That continues to accelerate with regards to its path into the summer of this year. So you've seen numbers come down fairly dramatically, and you started to see more conviction around, obviously, the stimulus that's coming in under the new administration. So the factors that you look at that, I think the market is starting to adjust in the sense that growth is going to pick up. You are going to see a tremendous year with regards to GDP growth, and there's more upside potential today than people thought a month ago.
Jim, it's Ed Hammond here. I just want to jump in on there before we get too far along. Look, your point about where we were last year and how sort of dark those days were is an interesting one, because now when we're looking at it, everything is so tight. I think if you look at the leveraged finance yields, if you look at the high yield, everything is trading kind of at or near record tights. So is the exuberance justified? Just if you look at it in terms of how quickly we've gone from that, as I say, very, very bleak period to where we are today.
I think it is. I think spreads are very supported. Now, the problem with spreads is that there's limited upside because of the convexity of the asset. Bank loans, high yield bonds, they've really priced in a lot of that recovery. So really what you're going to get is that interest rate. So I think high yield and loans will equate to about a 4 to 5% type return over the next several months. Over the next 12 months. As you said, from an absolute return standpoint, that's very different than the last 9 months.